Right now, while you're watching this video, while everyone's checking their portfolios and planning for retirement, the largest coordinated economic assault in modern history is already underway. And here's what should terrify you. This isn't speculation. This isn't theory. This is mathematical certainty. The exact same pattern that destroyed three major economic powers in the last century is playing out in the United States right now, stage by stage, almost like we're reading from the same playbook. And before this video ends, you'll see exactly where we are in that sequence and how much time we have left. In 1929, the United States had the strongest stock market the world had ever seen. The Roaring Twenties brought unprecedented wealth. Industrial production had doubled in a decade. Stock prices climbed 400% in just 9 years. Everyone believed America had entered a new era of permanent prosperity. Sound familiar? Within 4 years, unemployment hit 25%. Banks collapsed by the thousands, and half the nation's wealth simply vanished. In 1989, Japan controlled 40% of the world's stock market value. Their real estate was so valuable that the grounds of the Imperial Palace in Tokyo were theoretically worth more than all of California. Their banks were the 10 largest in the world. Within 3 years, their stock market lost 60%. Within a decade, their real estate crashed 80%. They call it the lost decade. But it's been 35 years, and they still haven't recovered. In 2007, the global financial system appeared invincible. Banks had sophisticated risk models. Derivatives spread risk so efficiently that Alan Greenspan called it the Great Moderation. Housing never goes down nationally. They said the models were perfect. 18 months later, Lehman Brothers collapsed. Bear Stearns evaporated. AIG required a $182 billion bailout. 9 million Americans lost their homes. 3 crashes, 3 different eras. 3 promises of this time is different. And every single time, the people in charge believed they had solved the ancient problems of boom and bust. They were wrong. Catastrophically wrong. Now let me show you something that should make your blood run cold. The United States in 2026 has completed every warning sign that appeared before each of those crashes. Every single one. And we've added 3 new factors that make this collapse potentially worse than all of them combined. This is the story of how markets die, why the people running them always think they're immune, and why the mathematics say we're next. Before we go further, if you value the kind of analysis that doesn't sugarcoat reality, that treats you like the intelligent person you are, hit that subscribe button. Because when this unfolds, and trust me it will, you'll want to understand what's happening and why most people never saw it coming. Drop a comment with where you're watching from, because I want to know who was paying attention when the warning signs were everywhere. Let me take you back to 1925. 4 years before the Great Depression destroyed a generation of wealth, the United States looked invincible. The stock market had become the national obsession. Ordinary people, secretaries, and shoeshiners were borrowing money to buy stocks. Margin buying, they called it. You could buy $100 worth of stock with just $10 of your own money. The other $90 was borrowed from your broker. And why not? Stocks only go up. Everyone knew that. The economic fundamentals appeared rock solid. Industrial production was soaring. New technologies like radio, automobiles, and electrification were transforming American life. Corporate profits were at all-time highs. The Federal Reserve, created just 12 years earlier, had finally figured out how to manage the economy, or so they thought. But beneath the surface, something dangerous was forming. Something nobody wanted to acknowledge because everyone was making too much money to care. Stage 1 was excessive leverage. By 1929, margin debt had reached levels never seen before. Investors had borrowed billions to buy stocks, creating a pyramid of debt stacked on top of debt. The stock market wasn't being driven by economic fundamentals anymore. It was being driven by borrowed money chasing higher prices. Stage 2 was wealth concentration. The top 1% of Americans owned 40% of the nation's wealth. The middle class was shrinking, while the rich got spectacularly richer. Consumer spending, which drives 70% of the economy, was starting to weaken because ordinary people had less money to spend. But stock prices kept climbing because the wealthy kept buying. Stage 3 was agricultural collapse. Farmers, who made up a quarter of the workforce, had been suffering for years. Crop prices had crashed after World War I ended and never recovered. Rural banks were failing, foreclosures were spreading. The Wall Street didn't care because farming wasn't sexy. Technology was sexy, cars and radios were sexy. Who cares about farmers? Then came stage 4, the breaking point. In October 1929, a few large investors started selling. not because they knew a crash was coming, but because they wanted to lock in profits. They were selling push prices down slightly. That triggered margin calls. Investors who had borrowed money to buy stocks were suddenly forced to either put up more cash or sell their shares. Most couldn't put up more cash. So they sold, and their selling pushed prices lower, which triggered more margin calls, which forced more selling. The death spiral had begun. On October 24th, 1929, Black Thursday, the market fell 11% in a single day. Bankers rushed in to buy stocks and stabilize prices. It worked, temporarily. 4 days later, on Black Monday, the market fell another 13%. The next day, Black Tuesday, it fell another 12%. And within a week, $30 billion in wealth had evaporated. That's about $500 billion in today's money. But the real destruction was just beginning. By 1932, the stock market had lost 89% of its value. 9 years of gains wiped out. Thousands of banks failed because they had invested depositors' money in the stock market. Millions of Americans lost their life savings overnight. Unemployment exploded. Breadlines stretched for blocks. The greatest economic power on earth was brought to its knees in less than 3 years. Now let's jump forward to 1985. Japan was the rising superpower. Their economy had grown faster than any other developed nation for 4 decades. Their manufacturing dominated the world. Sony, Toyota, Honda, these weren't just companies. They were symbols of Japanese superiority. Their stock market, the Nikkei index, had climbed relentlessly since World War II ended. Real estate prices in Tokyo had reached levels that seemed to defy gravity. A square meter in downtown Tokyo cost more than a house in most American cities. Banks were lending money based on the assumption that property values would keep rising forever. Just like Americans thought in the 1920s, just like we think today, the Bank of Japan had created the perfect economy. Or so they believed. Low unemployment, rising wages, technological innovation, trade surpluses with every major economy. They had figured out capitalism better than the capitalists. Then the exact same stages started appearing. Stage 1 was excessive leverage in real estate. Japanese banks were lending vast sums for property purchases. Buyers were taking out loans that assumed property values would keep rising 10, 15, 20% per year forever. The loan-to-value ratios were insane. People were borrowing 100%, sometimes 120% of a property's value. Stage 2 was stock market mania, disconnected from reality. The Nikkei had climbed from 6,000 in 1980 to 38,000 in 1989. Price-to-earnings ratios hit 60, more than triple what's considered normal. Companies were valued based not on their actual profits, but on the land they owned, which kept going up in value, which made the stocks go up, which made the land more valuable. A perfect circle. Until it wasn't, Stage 3 was the central bank losing control. The Bank of Japan realized things were getting out of hand. In 1989, they started raising interest rates to cool down the speculation. It worked better than they expected. Way better. Real estate investors who had borrowed at low rates suddenly couldn't refinance. Their monthly payments exploded. They had to sell properties to meet their obligations, but when they tried to sell, they discovered something terrifying. There were no buyers, not at these prices. Prices started falling, slowly at first, then faster. Then in a complete panic, on December 29, 1989, the Nikkei hit its all-time peak of 38,915. By October 1990, it had fallen to 20,000. Within 3 years, it had crashed to 14,000. Japanese banks, which had lent trillions against real estate collateral, watched their loan portfolios turn into toxic waste. The collateral was worth less than the loans, companies defaulted, banks failed, the government bailed them out, but the damage was done. Japan went from the world's hottest economy to stagnation that's lasted 35 years. Their stock market still hasn't returned to the 1989 peak. Young Japanese today have never known economic growth. They call themselves the lost generation. That's what happens when a bubble this big pops. That's what's coming here. Now let's look at 2007, because this one's fresh enough that some of you remember it. The United States had created what they called the Great Moderation. The Federal Reserve, led by Alan Greenspan and then Ben Bernanke, had supposedly tamed the business cycle. Recessions were a thing of the past. They had the tools, the models, the sophisticated understanding of economics that earlier generations lacked. And housing was the foundation of this new, permanent prosperity. Real estate never goes down nationally. They said it's the safest investment you can make. Banks created exotic new financial instruments called mortgage-backed securities, and collateralized debt obligations. These derivatives spread risk so efficiently that even risky mortgages became safe when bundled together. The math was perfect, the models were flawless, except they weren't. Stage 1 was subprime lending madness. Banks were giving mortgages to anyone with a pulse, no income verification, no down payment, adjustable rate mortgages that started low but would reset higher in 2 years. It didn't matter because house prices were going up 15% per year. You could refinance before the rate reset. Everyone wins. Stage 2 was leverage on top of leverage. Investment banks were taking these mortgages, packaging them into securities, and selling them to pension funds and insurance companies. Then they were using derivatives to bet on those securities. And derivatives on the derivatives, some investment banks were leveraged 30 to 1. For every dollar of actual capital, they'd borrowed $30. One bad bet and you're wiped out. Stage 3 was the ratings agencies lying. Moody's and Standard & Poor's were giving AAA ratings to securities filled with subprime garbage. Why? Because the banks creating the securities were paying the ratings agencies. Massive conflict of interest. Nobody cared because everyone was making money. Then came stage 4. In 2006, housing prices stopped going up. Then they started falling. Slowly at first, homeowners with adjustable rate mortgages tried to refinance, but couldn't because their homes were now worth less than their loans. They defaulted, the securities backed by those mortgages started failing, and the derivatives built on those securities collapsed. In March 2008, Bear Stearns, one of the oldest investment banks on Wall Street, failed. It was bought by JP Morgan for pennies on the dollar. The government said it was contained. It wasn't contained. 6 months. Later, Lehman Brothers, even bigger than Bear Stearns, filed for bankruptcy. The entire financial system seized up. Banks stopped lending to each other because nobody knew which banks were holding. Toxic assets, the commercial paper market, which funds day-to-day business operations, froze. Companies couldn't make payroll. The stock market crashed. The S&P 500 fell 57% from its peak. 9 million Americans lost their homes. 8 million lost their jobs. Retirement accounts were cut in half. The government stepped in with the largest bailout in history. The Federal Reserve cut interest rates to zero and started printing trillions of dollars to buy toxic assets from banks. It worked. Kind of the economy stabilized, but we never fixed the underlying problems. We just papered over them with more debt. Now here's where it gets really disturbing. Let me show you how all 3 of these crashes followed the exact same playbook, and then I'll show you why the United States in 2026 is following that same playbook, stage by stage. Like we learn nothing from history, every collapse starts with the same delusion, the belief that this time is different. In the 1920s, they said the Federal Reserve had figured out how to prevent crashes. In the 1980s, Japan believed they had perfected capitalism. In the 2000s, we thought derivatives had eliminated risk. All 3 were catastrophically wrong. The second element is always excessive leverage. Borrowed money creates artificial demand. When you can borrow 90% to buy stocks, or 120% to buy real estate, or 30 to 1 to buy derivatives, prices get pushed far above what fundamentals justify. The leverage makes the boom bigger and faster, but it also makes the crash more devastating. Because leverage works both ways. When prices are rising, your gains are multiplied. But when prices fall, your losses are multiplied. And worse, falling prices trigger forced selling as lenders demand their money back. The third pattern is wealth concentration. Before every major crash, wealth inequality reaches extreme levels. The rich own most of the assets, the middle class is shrinking, consumer spending weakens, but asset prices keep rising because the wealthy keep buying. This creates a disconnect between the real economy and the financial economy. The stock market hits new highs, while ordinary people struggle. It can't last. The fourth pattern is central bank incompetence disguised as competence. Every time the central bank thinks they have everything under control, they believe they're models. They trust their tools, they're convinced they can manage the economy with precision, and every time they're blindsided when something breaks, because complex systems don't break gradually. They break suddenly, and once the breaking starts, the central bank's tools are useless. You can't stop a bank run by lowering interest rates. You can't prevent a margin call cascade by printing money. The mechanisms that cause crashes are mechanical, they're automatic, they don't respond to central bank policy. So here's the terrifying question. Where is the United States right now? Let me show you the evidence piece by piece, and you tell me if we're following the same pattern. Stage 1, excessive leverage. Check corporate debt in the United States has reached 47% of GDP, the highest level outside of a recession in recorded history. Companies borrowed trillions at low interest rates during the pandemic. Now rates have risen, but the debt is still there. Student loan debt is $1.7 trillion. Credit card debt just hit a new record. Auto loan delinquencies are spiking. Margin debt, money borrowed to buy stocks, is near all-time highs again, just like 1929. Check stage 2, wealth concentration. Check. The top 1% of Americans now own 32% of all wealth. The bottom 50% own just 2%. This is approaching 1920s levels. The middle class is getting crushed by inflation, healthcare costs, housing costs, education costs, but the stock market keeps hitting new highs. Why? Because the wealthy own most of the stocks they keep buying. And the disconnect between Wall Street and Main Street has never been wider. Just like before, every previous crash, check. Stage 3, asset prices disconnected from fundamentals. Check. The stock market price-to-earnings ratio is 25, well above the historical average of 15. Housing prices are at all-time highs relative to income. It now takes about 8 years of median household income to buy a median-priced home. In the 1990s, it took 3 years. Commercial real estate is collapsing, but residential prices keep climbing. Cryptocurrency market caps are in the trillions based on nothing but speculation. People are buying digital images of monkeys for hundreds of thousands of dollars. This is tulipmania-level insanity, and everyone says it's fine because we live in a new paradigm. It's never different. Check. Stage 4, central bank losing control. Check. The Federal Reserve raised interest rates from 0 to 5.5% in less than 2 years, the fastest rate hiking cycle in history. They did this to fight inflation, and it worked. Sort of, inflation came down from 9% to 3%, but now they're stuck. They can't cut rates much because inflation is still above target. But they can't keep them high because it's crushing the economy. Small banks are failing. The commercial real estate sector is imploding. Credit card defaults are rising. And here's the key. The Fed's balance sheet is still bloated with $7 trillion in assets they bought during the pandemic. They're trying to shrink it, but it's like trying to drain a bathtub while the faucet is still running. Stage 5, and this is the new one that didn't exist in previous crashes. The global reserve currency is under attack. For 80 years, the US dollar has been the world's reserve currency. Every country needs dollars to buy oil, to trade internationally, to hold as reserves. This gave the United States an enormous advantage. We could print money and export our inflation to the rest of the world, but that system is breaking down right now. China just sold over $100 billion in US treasuries in the past year. They're not buying our debt anymore. They're dumping it. The BRICS nations, Brazil, Russia, India, China, South Africa, are creating alternative payment systems to bypass the dollar. Saudi Arabia is accepting yuan for oil sales, not just dollars. This is unprecedented. When the world stops needing dollars, when central banks stop holding our debt as reserves, the value of the dollar will collapse. And when the dollar collapses, everything priced in. Dollars, stocks, bonds, real estate, all of it reprices lower. Much lower. Think about what this actually means. The petrodollar system, created in 1974 when Henry Kissinger made a deal with Saudi Arabia, required all oil to be purchased in US dollars. This created artificial demand for dollars. The countries needed to hold billions in dollar reserves just to buy energy. That's 50 years of guaranteed demand for our currency. It let us run massive trade deficits without consequences. It let us print trillions without hyperinflation. It was the foundation of American financial dominance, and it's ending right now in real time. When Saudi Arabia announced they could accept other currencies for oil, that wasn't just a policy change. That was the official death notice of the system that's funded American empire for half a century. The implications are staggering. Countries holding trillions in US treasuries will start diversifying, not all at once, because that would crash their own holdings, but gradually, persistently, relentlessly. This creates a permanent downward pressure on treasury prices. And remember, when bond prices fall, yields rise. Higher yields mean higher borrowing costs. Higher borrowing costs mean the US government has to pay more to service. Is $34 trillion in debt? More debt service means less money for everything else, and it becomes a vicious cycle that has no good ending. We're not at the beginning of this pattern. We're not approaching it. We're deep inside it. We've already completed stages 1 through 4. Stage 5 is happening right now. The only stage left is 6, the collapse. And here's what history tells us about that final stage. It doesn't happen gradually, it happens fast. The 1929 crash went from peak to chaos in 3 weeks. Japan's bubble popped in less than a year. The 2008 crisis went from Bear Stearns to complete meltdown in 6 months. These things don't decline gently. They implode. Why? Because of feedback loops. Falling prices trigger forced selling. Forced selling triggers more price declines. More declines trigger more forced selling. It's a death spiral. And modern markets, with their algorithms and high-frequency trading and interconnected derivatives, will make the next crash faster and more violent than anything we've seen before. The machines are programmed to sell when volatility spikes. When everyone's selling at the same time, there are no buyers. And when there are no buyers, prices freefall until they find a level where someone is willing to step in. And that level could be 30, 40, 50% below where we are today. Now let me show you the 3 factors that make this coming crash potentially worse than 1929, worse than Japan, worse than 2008. First, the everything bubble. In past crashes, one sector collapsed. Stocks in 1929, real estate in Japan, housing and derivatives in 2008. This time, everything is in a bubble simultaneously. Stocks are overvalued, housing is overvalued, bonds are in the biggest bubble in history because interest rates were held at 0 for 15 years. Cryptocurrency is pure speculation. Even art and collectibles are at record prices. There's nowhere to hide. When this pops, there's no sector that will hold up. Second, the debt levels are unprecedented. The total debt in the U.S. economy, government, corporate, and household, is 350% of GDP. In 1929, it was 200%. In 2008, it was 250%. We've never tried to deleverage from these levels before. Nobody knows what happens, but history suggests it won't be pretty. Third, the political and social instability. In past crashes, Americans still had basic trust in institutions. That trust is gone. Half the country doesn't believe the other half has legitimate grievances. Congress is paralyzed. The courts are politicized. When the crash comes, when people need their government to act decisively, we'll discover we don't have a functioning government anymore. We have 2 tribes screaming at each other. That makes everything worse. Here's the part that nobody wants to hear. This isn't a problem you can vote your way out of. This isn't about Democrats or Republicans. Both parties created this mess. Both parties benefited from it. Both parties will be powerless to stop what's coming because the crash, when it comes, isn't a policy failure. It's a mathematical inevitability. You cannot borrow forever. You cannot print money forever. You cannot have asset prices rise faster than incomes forever. Eventually, the math catches up. And when it does, all the clever theories and sophisticated models and expert predictions are revealed as nothing but hopeful delusions. 3 times in the last century, major economic powers thought they had figured out how to prevent crashes. 3 times, they were catastrophically wrong. The 1920s, Americans believed the Federal Reserve had solved boom and bust cycles, and within a decade, unemployment hit 25%. 1980s, Japan believed they had perfected capitalism. Within a decade, they entered a stagnation that's lasted 35 years. 2000s, America believed derivatives had eliminated risk. Within 2 years, the entire financial system nearly collapsed each time. The people in charge believed they were different. They believed the old rules didn't apply. They believed this time really was different. They were wrong every single time. And we're telling ourselves the exact same lies right now. We're different. We have the world's reserve currency. We have the strongest military. We have Silicon Valley. We're America. The rules don't apply to us. But the pattern doesn't care about exceptionalism. The pattern doesn't care about military power or technological innovation or national pride. The pattern is mathematical. And the mathematics say we're next. You cannot have excessive leverage without forced liquidation. You cannot have extreme wealth concentration without demand collapse. You cannot have asset prices disconnected from fundamentals without violent repricing. You cannot have a central bank that's lost control without market chaos. You cannot have the reserve currency under attack. Without currency crisis, the sequence is locked in, the stages are complete, the only question is timing. Maybe we have 6 months, maybe we have a year, maybe we have 6 weeks. Nobody knows the exact date, but the pattern says the collapse is coming. And when it comes, it won't be gradual, it won't be manageable, it'll be sudden, violent, and complete. The stock market will gap down, opening 10, 15, 20% lower than it closed. Retirement accounts will be cut in half before most people even realize what's happening. Banks will freeze withdrawals. The government will step in with emergency measures. But this time, those measures won't work, because this time we're out of ammunition. Interest rates are already low, the Fed's balance sheet is already bloated, government debt is already at wartime levels, there's no dry powder left, when the crash comes. We'll learn the same lesson every empire learns. You're not special. You're not different. The laws of economics apply to you just like they applied to Rome, to Spain, to Britain, to every empire that thought it would last forever. They all believed they were exceptional. They were all wrong. And here's what makes it even more dangerous. The safety nets people think exist don't actually exist. The FDIC insures bank deposits right up to $250,000 per account. Sounds safe. Except the FDIC has about $125 billion in its insurance fund, and there's over $10 trillion in insured deposits in the US banking system. Do the math. If even 5% of banks fail, the FDIC is insolvent. They'll have to go to Congress for more money. Congress will fight about it for weeks while your money sits frozen. Your 401 kilobits is protected by diversification, right? Stocks, bonds, maybe some international exposure. Except in a real crisis, everything falls together. Diversification only works when different assets move in different directions. In 2008, correlations went to 1. Everything crashed simultaneously. Bonds were supposed to be the safe haven. They crashed too. The only thing that held value was cash, and even that was risky because banks were failing. Gold spiked, then crashed, then recovered. It was chaos, and this time will be worse because the starting point is more extreme. We'd never had everything in a bubble at the same time. We'd never had this much debt. We've never had this level of political dysfunction. If this analysis opened your eyes to what's actually happening, if it showed you the pattern that most people refuse to see, subscribe to this channel. Because when this unfolds, and it will unfold, you'll want to understand what's happening and why the answers aren't hiding in the future. They're written in the past, in the rubble of every empire that ignored the warnings. Drop a comment below and let me know where you're watching from. I want to know who was paying attention when the signs were everywhere, when the pattern was obvious, when the mathematics made it clear that the crash wasn't a possibility but a certainty. The people running the system know this is coming. That's why they're moving their wealth to safety while telling you everything is fine. They need you to stay in the market, to be the buyer of last resort, to hold the bag when the music stops. Don't be that person. The stage is set, the pattern is complete, and history says we're about to learn the lesson the hard way.